All right, so today I wanted to do a stock analysis on a company I've never talked about before, and that's Microsoft. Again, everyone knows that Microsoft is almost a $2 trillion market cap, very large company. Um, and getting right into it here, let's look at the dividends first. This is a company that's growing its dividend very nice. They're basically raising it every year. I mean, just like clockwork, 10% a year. Dividend yield is currently only 1%. The payout ratio is about 30. So if they wanted to pay all the earnings as if or all the free cash flow as a form of a dividend, they could pay about just over 3%, which honestly should be a little bit higher than that. This is something that is a little bit concerning to me that the earnings yield isn't a little bit higher. But these kind of companies tend to not have super high earnings yields because they are more on the growthy side. So if we get into the financials here, this is something I always like to look at. Let's go down to free cash flow first. So free cash flow is growing very, very nicely. Basically, each of the last 7 years, it's grown, and it's growing also very, very quickly too, which is very impressive. Um, so that's something I like. They are consistently buying back shares. They haven't issued a new share in at least 7 years, which is very good. They've been paying down debts ever since 2017, which is also a very good sign. If we look at the metrics here, we can just do it through the insights. Let's just take a quick look here. Um, Analysts are bullish. Their balance sheet looks solid. It's not great, but it's definitely solid. The growth is a little bit concerning because revenue is going up nicely, but net income and operating cash flow are not. Very profitable, very good returns, almost perfect. If you look at that again, 29% or sorry, 36% return on equity. Again, very strong. Um, if we look at the valuation, though, this is the only concern here, right? This is a concern with a lot of companies still. That is not where we want it to go. So again, if we go into the free form tool here, let's look at the valuation on it. This is the one concern I have. So again, if we go back, this is 2014 till now. Average price of free cash flow 24.53. The latest is 33. So this company definitely is expensive. If I was setting a price target for Microsoft, again, if you're a long-term holder, I'm talking 10, 20, 30 years, you could probably start to dollar cost average now. Again, obviously everything my opinion, but you also need to keep in mind that over the short run, we could see a lot of volatility, right? And a lot of people are not going to be okay with that. So that's something you really need to keep in mind. So again, where would I look at picking it up? Preferably around 200. I mean, it's currently at 258, but if I could get it below like 220, I think that that's probably a fair price. Fair value for it's probably, I don't know, 220, 230, probably around 220. So if you could get it for around there, that's where I would look to pick it up. So, I mean, if we compare it to, let's compare it to some other ones of the big tech stocks here. If we look at Google, um, Amazon's not a great comparison, so I won't add them. Let's add Meta, which I'm also not a huge fan of, but that's a different story for a different time. So again, let's look at them. Price to free cash flow. Again, Meta is quite a bit cheaper, although to be fair, I think that the whole Meta, rebranding was a bad decision, and I hardly know anyone who doesn't think that. So again, it's definitely going to be cheaper, but I mean, if we look at Google, I think honestly right now Google is the most attractive company as far as if you can get Google below $90, I'm all over it. Below 85 or 80, that's a steal of a deal. Below 100, I'm still okay. I think 100 is probably roughly my cutoff. But I mean, if you look at the latest number, it's got a 22.4 price to free cash flow. Average is 29. Although you got to keep in mind too, when it comes to these growth stocks, even the average for most of them is still going to be a little bit overpriced. So I'd want to get it like 10 or 20% below the average just to be safe, right? Because I think the previous 10 years or so has been better for growth stocks than the long run or the long run average, right? If you go back like 50 years, right? So for growth stocks, I'd want to get them not only below the average, but like 10 or 20% below. Um, Meta, again, has a higher average, but it's lower, right? But I think that that's for good reason. So, and given the amount that it's gone up over the last week or so, I would still be concerned about them because I very unpredictable in my mind. I think that Google's a lot safer, Amazon's a lot safer, Microsoft is even a lot safer of these big tech companies, of the FANG names, although I think Netflix is probably not going to be in that for long. Same goes for Meta. Again, just my opinion. I just think the whole Meta rebranding was not a good idea because, I mean, Facebook was a cash cow, right? I mean, they were just printing cash before that. Why the rebranding? I don't understand. I don't. Maybe they wanted to. I think I know why they did it. To me, it just doesn't make sense. I wouldn't have done it. So again, that is Microsoft. Again, very, very good company. Although the one problem we're going to run into with a lot of these big tech companies is that they already are so big that how are they going to grow significantly in the future? Like, you only have so much room to grow. So this is why I'm saying that you should be trying to buy these companies below valuations because they're not going to be able to grow at the rate they did over the last 10 years. And on top of that, they were artificially expensive during that time. So again, you got to be very careful with growth stocks, in my opinion. Again, they're the sexy names, but you got to be very careful because if you overpay, you could get burned. So anyway, that's just my opinion on Microsoft. If you liked the video, hit that like and subscribe and stay tuned for